So welcome everyone to today's webinar. This is part of a series organized by the E-Access Forum on Climate Change, Macroeconomics and Finance. In addition to the webinars, you will be able to join the forum on Slack. The aim of the forum is to aggregate researchers, regulators, central bankers working on topics linked to climate change and the environment. And on Slack, you will be able to find working papers and news about conferences and events. So one of the organizers will now post the link to Slack in the chat. My name is Emanuele Campiglio. I'm an associate professor at the University of Bologna in Italy, and I will be the chair of this event. Let me introduce you immediately to tonight's speaker, Rick van der Ploeg. So Rick is professor of economics at Oxford University, where he is also the research director of the Oxcarre Research Center. He has an affiliation as professor of environmental economics at the University of Amsterdam, and he was formerly at the University of Cambridge, LSE, the European University Institute, and Tilburg University. He has many research interests spanning macroeconomics, public finance, and development, but probably what he's most well known for are his numerous contributions in the field of environmental and resource economics, where he can now be considered a household name. What is also special about Rick is that he had direct experiences as a policymaker, as he was State Secretary of Education, Culture and Science in Netherlands, as well as a member of the parliament. He is also a former member of the UNESCO World Heritage Committee, and he has consultancy experience with the IMF, OECD, European Union, World Bank, and many other private and public organizations. So we tested this modality of catching your opinions at the very start of the webinar last time with Pierre, and we will try it again. So now the organizers will make the poll appear. I will give you around 60 seconds to answer. So the first question is, should central bankers be concerned about climate change and adjust their policy accordingly? And then we have a question about carbon tax. Should it start low and rise quickly, start high and rise slowly, or start high and decline? I will give you a few more seconds. Right, so these are the results that we obtained. Okay, so an overwhelming majority for yes. Central banks should be concerned about climate change. And a carbon tax, okay, so we have 41% saying start low and rise quickly, 52% start high and rise slowly, and 8% start high and declined. And I think, Rick, you will give us your opinion on that now. So before leaving the floor to Rick, let me explain how this event will be structured. Rick will speak for about 40 minutes. Please feel free to pose your questions in the chat during his presentations. If these are immediate clarification questions, I will briefly interrupt Rick so he could explain, so that we're not leaving anyone behind. I will instead postpone deeper questions to the Q&A section. At that point, I will give you the opportunity to ask your question directly. So I will allow you your microphone, or if you prefer, again, you can post your question in the Q&A and I will read it for you. This is it for me. So I will now leave the floor to Rick van der Ploeg, and thank you very much, Rick, for being with us.
Thank you very much, Emanuele, and the others also for this very kind invitation to talk to you. I will now try to share some slides and then I'll start my talk. I think that should not be too difficult, but let's try and see it. Yes, you see there we got you. And then I should be able Have you got me now? Have you got my slides? Yeah.
Yes. Thank you.
So the topic is climate risk, carbon pricing, and financial policy. And I will also talk a bit about challenges in pricing carbon. I will try to keep it as non-technical as possible. So I will try to keep it more about policies and empirics. So this is my outline. Let's see how far I get. I try to get at least 2.7, and we'll see how it goes. So it'll become clearer as I go along. So the picture everybody knows is this picture that when you start at point 0, which is the beginning of the industrial period, people started using coal. Then man-made emissions, anthropogenic emissions started going up since 1870. And as that went up, temperature rose. So temperature is typically measured in climate literature from the beginning of 1870 onwards. And then what you see is this line going up, and you see that the data is this black line going up to up here. And then later on, there's a huge number of predictions by large scientific models. But there's the overwhelming evidence that the more emissions, the higher the temperature. So even if you're a climate denier, these are the bands, the confidence bands. So it may not be as high, and maybe a bit higher, but it's clearly there's an upward connection. So this is why we're concerned. And so then when policymakers decide to have a 2-degree target or a 1.5 degree target, you can read off on this line how much the total amount of cumulative emissions is. So a cap on temperature, a ceiling on temperature means a cap on cumulative emissions. And that's what we'll use again and again. So this is just by way of introduction. So and then the end, so therefore you need to price carbon. The golden policy is to price carbon. And the way to price carbon, you can do it either via a carbon tax, you can do it via a permit market like in Europe, or like increasingly in China, increasingly in parts of America where Trump couldn't prevent them doing it. And then why do we price carbon? I find that talking to policymakers that they don't appreciate the subtleties why pricing carbon is such a strong incentive. Yes, it does curb demand for fossil fuels. You put on an extra jumper and you put your heating lower. You use the bicycle instead of the car. But it also, pricing carbon is the best way to encourage owners of oil deposits and owners of coal deposits and gas deposits to keep the stuff in the ground. And we need to keep the stuff in the ground. We're only allowed to use maybe half of oil reserves, or we have to keep 80% of coal in the ground. Thirdly, what it does is pricing carbon. It means that we stop using tar sands, coal and oil, and maybe switch to gas in the short run. There's a window of opportunity where we can temporarily use gas. Eventually, we have to get rid of gas as well. It also pricing carbon. Without pricing carbon, there's no good renewables industry. So if you price carbon, it really induces substitution from fossil fuel towards renewables. Also, without pricing carbon, you wouldn't have a market for carbon capture and sequestration. But the price of carbon is really the price of carbon capture and sequestration. So without pricing it, you have to subsidize CCS, but it's not going to happen. So the best and the most efficient way is for that as well. By pricing carbon, you may also limiting the slash and burning of forests. That forests get conserved, and by doing that, you conserve CO2 absorbers. CO2 is then still possible to remain absorbed by the forest. Lastly, the last two things I spent more on R&D in clean fuel alternatives like solar and batteries and wind energy and maybe even fusion energy. So all of these things for pricing carbon are very important. And I end with the last thing. So many countries have started adopting pricing carbon and getting rid of fossil fuel on the roads and elsewhere, not to fight global warming, but just to have a better air quality. So the IMF, particularly Ian Parry, there has spoken a lot about collateral benefits from fighting global warming, that you get lower air pollution. It's particularly good for infants in cities, that they have less asthma and less lung-related diseases, and it really saves lives. So and the advantage of these collateral benefits, they're local. Whereas the benefits of reducing global warming, they're global, so you have all these free rider problems. So this is, in one slide, why we need to price carbon, why it has all these extra benefits. So why does it not happen? Why does it happen so slowly? Why only Sweden and a few other countries? So Well, the first thing, so before you even start to price carbon, there's some no-brainers, which governments are not doing either. The first thing is then there should be a moratorium on coal immediately. But coal is still being used. In fact, about fossil fuel subsidies are about 6 to 7% of world GDP. So this is estimates of the IMF. So the first, before you even start thinking, before you start even discussing, before you start even pricing carbon, just get rid of all the subsidies for coal, oil, and gas. And countries are doing that, and I'll explain it a bit later why they're doing that, but that's just very bad. A second challenge in pricing carbon, that it's just one of the biggest problems on the planet. It's a big ask, because on the one hand, it's a huge international free riding problem. Each country will say to the other country, well, if you reduce your emissions, and then they wait, and if the others have done it, they feel they don't have to do it anymore. So everybody is waiting for someone else, so nobody else is doing it. Because everybody is worried that if they go first before the others, that they may lose a competitive advantage, and that all the others, that if it goes first, that it will lose business to countries that are not pricing carbon. A second reason why it's a big ask is that current generations, the current young, they're not all like Greta Thunberg, are asked to make sacrifices to curb future global warming. And that will benefit the future richer generations, which may possibly be very well be richer. So what you need, and it's a very complicated problem. I only know one good paper on this thing by Kotlikov. Kotlikov is the world's expert on overlapping generations. And he's shown empirically that if you can actually get a Pareto improving win-win situation where all cohorts, all generations can improve. So the current generations and all future generations, but you have to run up the government debt a little bit, and you have to give transfers to the current generation to make sure that all generations win. But anyway, so it's a big thing to get it to coordinate it, that all countries want to do it. 30 years of climate negotiations hasn't worked. And it's a big problem because you have to solve this generational problem. The third problem is that you need transfers from rich to poor countries. It's been argued again and again and again by economists that we need a uniform price for carbon throughout the globe. But clearly hasn't happened. And the only way it can happen is that if the rich countries really compensate the poor countries for imposing carbon prices. The benefits from poor countries pricing carbon are much, much larger than the cost of those transfers, as has been shown by the recent presidential lecture at the European Economic Association by Per Cruzel. And we've seen every time, again and again, it's not happening. Fourth problem is climate policy and carbon pricing tends to be regressive. It tends to hurt the poor more than the rich. So you need to recycle these regressive carbon tax revenues or the permit revenue to give it to lower income groups. If you don't do it, you're just going to get the yellow vests. It's going to be just a pain in the neck. You're not going to get it politically across the line. So what we've shown, for example, in the paper of Armin Rezai, to get majority support for green tax reform, you can't just if you recycle all the revenue as lump sum transfers, as dividends, then basically that's inefficient and the economy shrinks so much that that's not very good. Basically, people get lazier. So what you need to do is to use part of the revenue to lower income taxes and part of the revenue to increase your dividends. And then you can have both equity and efficiency. And that's what we show below on the table here, that if you do a combination of those two, you can actually get it across the line politically. But the main point is you have to address the issue that carbon pricing is regressive, and you have to do something to get it across the line. So you need for that an upfront, visible and uniform carbon dividend, or even a directed transfer to the lowest incomes. France has taken a different approach. They give insulation subsidies for the low incomes because poor people often live in badly insulated houses. If people live in use cars, the poor often use cars that are older and that are dirtier. So maybe give them subsidies to change and things like that. And then finally, you may want to use some of the revenue to give the firms that are most at risk of leakage from competition from abroad, from dirty products, that they get the rebates proportional to production. Okay, the fifth problem is what I've already said, is this international free riding. So if you price carbon, then you get a problem. Why do you get a problem? If you price carbon and your neighbors do not, then part of the price of carbon is like a tax. Is shifted to producers, and part of it is paid for by consumers. The extent to which it's shifted to producers lowers world prices of fossil fuel, of oil, gas, and coal. So that means that demand for gas, oil, and coal outside your country will go up. That phenomenon is called carbon leakage. So the only way to avoid carbon leakage, so that if you're trying to cut carbon emissions, that carbon emissions of your neighboring countries goes up, is to have border tax adjustments. And that means that you tax the import of products from countries that do not have a carbon tax, that don't have a low carbon tax, such a way that you get a level playing field. Another way of doing it is to have tariff clubs. That's a proposal by Bill Nordhaus, the Nobel Prize winner. And he says, let those people who want to move along with carbon taxes, let them put a tariff around their countries and then make it more difficult for countries outside the carbon taxing zone to import to them. And then as soon as they join, they can benefit from not having to pay the tariffs. He then shows in an analytical paper that you can then get a positive spiral where more and more people want to join the club. A sixth problem is something many people have written about following Hans Werner Sinn. It's called the green paradox. So politicians are and I know as a former politician, a former minister, a former member of parliament, that politicians love two things. One, they prefer to postpone and leave nasty things for their successor. And secondly, they prefer the carrot to the stick. So they, on the one side, they want to postpone carbon taxes, or they want to replace carbon taxes by renewable energy subsidies, like solar subsidies, like Germany has done on a large scale. So basically what that's doing, it's telling oil sheiks to pump up the oil as fast as they can to avoid the capital losses that will come when carbon taxes will be rising in the future. So what is happening, this tendency of politicians to procrastinate accelerates global warming, especially if the supply of fossil fuel doesn't respond much to prices. Seventh challenge that has to be overcome is a problem of policy failure and capture. Many people, if they don't use carbon pricing, then use non-price controls. I know this very well from my own countries, the UK and the Netherlands. I'm half English, half Dutch. They might have things like efficiency standards. There's grandfathering in the European permit schemes. And of course, there's an enormous instance where government thinks they know better than the market, and the government picks winners. So they say particular solar or particularly algae, they're going to get the subsidies, and rather than letting the risk-taking being happening by the market, as would happen under a carbon tax. And then, of course, if you don't use carbon pricing, we have evidence again and again, and the academic literature has lots of papers as well, that will lead to lobbies, and it will lead to a lot of inefficiency. So normally, if you just have a school example in microeconomics 101, you have a demand curve and a supply curve. This is the size of the tax. And then this point A is what's called the Harberger triangle. And that's the normal welfare losses from carbon taxation. So it's just a small triangle. Now, the problem with this lobbying and this rent seeking is that this cost, that this lobbying and rent seeking, will let this whole area B, very large, will be dissipated as well. And that's the true cost of if you don't have a carbon tax. It's not just the welfare. These are the distorting costs of distorting relative prices. And this is the cost of rent seeking. And we want to avoid at all costs that the market, there's rent seeking going on, leading to these extra costs B. And unfortunately, if you don't have carbon price with something else, then typically a lot of those extra costs come in. Okay, then final 2 points. One is spatial needs. People underestimate how much demand there is going to be on the pure square meters of a country to really make the green transition. You need, and there's just not enough space for even, definitely not in a country like Holland, and definitely not in a country like Germany even. And in the UK, it's only possible because they put everything in the sea. So there's just not enough space for all the windmills on the land, all the solar panels, all the hydrogen factories, and all the carbon capture sequestration stuff to put it in the landscape or in the sea. It's a huge challenge. And if it's on the land, you get all the NIMBY politics. This is an item which is very under-researched by economists, but it's a colossal political problem. I actually think this, when I was in the Netherlands, we tried to do it, this was one of the biggest political issues in the Netherlands, and it still is. People don't accept windmills, they don't accept solar panels, and they think it's going to ruin their landscape. And of course, at the same time, we need to do it. So if you can go to the sea, then it's a bit easier. The final big thing is climate skepticism. Okay, maybe Trump is the only one who thinks he still won the election, but still the issue of climate skeptics is still very large. So there's a huge battle between climate skeptics and scientists. And I think it's a bit like Pascal's wager, bless Pascal, the wager whether one should believe in God or not. Of course, atheist, if you're a real atheist, rigid atheist, you'll never believe in God. But agnostics, if you're a doubter, you might believe in God, because the cost of not believing when God does exist are huge. You have to go to hell. While the gain of believing when God does exist are huge too. You're heaven. So if God doesn't exist, the cost of believing is very small, whilst there's a small gain from not believing. So it's not difficult to see that the max-min policy is to believe in God. The same argument can be used to deal with climate skeptics. So you could argue that if you treat the people who are climate skeptics a bit like the doubters, the agnostics, then you really don't want to. It's too costly to believe that the climate skeptics are right, because the cost of believing the skeptics when they're wrong is huge. Because if temperature goes from 3 or 4 degrees and you've not done anything, like Trump would have said, the costs are colossal. Whereas if you're following the scientists and pricing carbon, and the scientists turn out to be wrong, a very small chance, I think, then the cost of that is just the Hallberger triangle, a little bit of welfare cost. It's much smaller. So every empirical study on this suggests that then the max-min policy is to price carbon vigorously, even if you take the climate skeptics seriously. So I showed it in that top table 3, that there the max-min outcome is clearly to price carbon and to believe in the scientific outcome and not the denier outcome. So let's not go in the numbers, but basically the costs of believing the skeptics are just too high if the skeptics are wrong, whereas the cost of believing the IPCC, if the IPCC turns out to be wrong in the unlikely case, are just very small. After all, you're rebating the carbon tax revenue. So the thing is, even with climates, and I found this argument quite strong even when speaking to climate deniers. So now let's come to the questions, the second question first. So what should we do to price carbon? Well, first, I think we should credibly commit to a rising path of carbon prices. Why do we think that? I think we should even put it in the Constitution. We should really tie our hands to it. The government should put it in the Constitution for the next 30 years. Why is that? Because businesses and corporations need to know that the rules of the game have changed. So they need to know that when they make their investments in green and not in brown, that it's going to be the new rules of the game are that green is going to be profitable and brown is not going to be profitable. That really, if you're going to still keep on investing in coal or fossil fuel intensive industries, then really you're going to be a thief of your own purse and you're going to be bankrupt. So the idea is, and then if you have fickle governments changing it all the time, which is of course we do have, but that's something we have to try to avoid. I mean, Obama was well intended, but then we had 4 years of Trump, and now it's up to Biden to reverse it all. So we have policy uncertainty, and that's true in every country. So the first thing, credibly commit to a rising path of carbon price. Now there are 2 approaches. The approach used by Bill Nordhaus and many economists is the PIGOUVIAN approach. So you set the carbon price to something called the social cost of carbon, which is the expected present value of all present and future marginal damages from emitting 1 ton of carbon today. We can calculate. There's a whole business of people who can calculate that. And then the question is, what's the best discount rate to use? I'll talk about it in a minute. And you have to take account of all kinds of uncertainties, tail risk, and tipping points. Then there's the second approach. That's the IPCC approach. And they say, well, forget about welfare. And we just take something, a different focal point. Let's have a 2-degree cap on temperature or a 1.5 degree cap on temperature. And as I said already, that corresponds to a cap on cumulative emissions. And it also depends on economic and climatic uncertainties. It depends on risk tolerance and things like that. So what we're going to do for the PIGOUVIAN approach, I would like to call your attention to perhaps the most important paper in climate economics written in the last 5 years. And that's a paper by Burke, Solomon Hsiang in Nature 2015. And there they estimate the damages from temperature changes. So if you look on the horizontal axis here, 1 degree temperature since the pre-industrial period, 2 degrees temperature, 3 degrees, 4 degrees, 5 degrees temperature. And then on the vertical axis, you see the percentage falls, drops in GDP per capita. The blue line is probably the best line to take, but it doesn't really. They're huge. You can go up to 40, 50% drop in GDP, half GDP, if your temperature goes up to 5, 6 degrees. But even if it goes up to 3 degrees, you still get a 30% drop in GDP. Now look, here's DICE, here's PAGE, here's FUND. All the modelers use FUND, PAGE, and DICE. And they have damage functions made up out of thin air, or made up out of made up numbers, or made up out of old studies of 30, 40 years ago and then blown up to the whole world. So these are not reliable econometric studies. This is a reliable econometric study, and notice that they're much, much larger. Secondly, what you see, if you look at the left panel, you see that if you look at as temperature goes up, this is along a business as usual path, you see that the richest countries don't lose much in GDP. Some of them may even gain a bit, whereas the poorest countries lose most. So the poorest countries lose much more than the middle countries, and the richest countries don't lose much at all. So what we see here very clearly is that from global warming, most of the costs are borne by Africa and the poorest countries on our planet. And secondly, that maybe the damages are much, 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 much higher than what is assumed in most integrated assessment models. So that's the first thing. So what we then see is, if you just ignore the calculations, but just look in blue, if you take the Burke et al. Estimates, we get a carbon price of about $245 per ton of CO2. It's huge. Whereas if you take the Nordhaus damages from his DICE model, his latest DICE model, then the damages are about $68 per ton of carbon, about $18 per ton of CO2. So these are about 15 times higher on the Burke. So there's a huge disagreement on what it is. I think I put my money here on the Burke et al. Model and not on the DICE fix. But whatever it is, economy, and another reason why these estimates differ a lot is not just because different disagreement about what are the damages. So there's a lot of damage uncertainty that in itself would push up the PIGOUVIAN price for carbon. But secondly, there's a lot of uncertainty about the discount rate. The whole debate between Lord Stern and Nordhaus was about what kind of discount rate to use. Stern followed Frank Ramsey of King's College, the disciple of famous mathematician, but the protege of John Maynard Keynes, who said to discount is ethically indefensible. And so therefore Stern comes up with much, much higher carbon prices. He would like this, but he would get these carbon prices not because of the damages of Burke, but because of his discount rate being small. Whereas Nordhaus uses a discount rate of 1.5%, but he calibrates his models to market rates of return. So if you did Stern, and if you did Burke damages, this thing would go a lot more. If you also allowed for tipping points and all kinds of climate risk, it would go up even more. So the idea is, what I'm trying to say is that even with the PIGOUVIAN approach, don't just look at Nordhaus, but then you think you would even go over 2 degrees Celsius. You go to 3 degrees Celsius. But it's just because the damages are too small and the discount rate Nordhaus uses is too small, and you don't allow enough for tipping points and other climate risks. If you do, you get much, much higher rates of carbon prices, and you would automatically stay under the 2 degrees thing. So given that disagreement, it's not that surprising that the IPCC has decided to go for this temperature cap approach. And it's not just the IPCC, the Network for Greening the Financial System, Inspire, central banks, all of these guys, they adopt 2 degrees caps on temperature. And many, I think probably people like Emmanuel would also use a temperature cap or a 1.5 degree temperature cap. And I can understand that given the huge disagreements. So you typically say that from 2014 onwards, we maybe can spend another 150, 314 gigatons of carbon. Whatever it is, it's about 15 to 13 years left. I think this actually, if you have a 1.5 degrees cap, you have a tighter risk tolerance. We only maybe have 2 years left. So there's not so there is a point of no return. It's quickly being reached. The PIGOUVIAN price of carbon rises at the rate corresponding to the rate of growth of the economy, say 2% or 1.5% per year. But here the carbon price needs to grow at a rate equal to the risk-adjusted interest rate. So if you use this IPCC approach, it's not often appreciated. There is something to be indifferent between emitting a ton of carbon today and emitting a ton of carbon tomorrow. You have to satisfy an arbitrage principle. And you're only indifferent between doing that between now and tomorrow if the carbon price grows at a risk-adjusted rate of interest. So that is why the blue line, the purple line is the Nordhaus line, carbon prices, and this is the IPCC approach, which is then the dotted line. So it goes,
Rick,
yeah.
Sorry to interrupt because you're talking about DICE again. There was a question in the Q&A section, just a clarification question saying, I thought Nordhaus used a discount rate of 6% and not 1.4%. I was wondering whether you could clarify this. And then there's also a question, why GDP per capita could go up with 5-degree temperature rise, which I guess means how is it conceivable that GDP per capita could go up with a 5-degree temperature rise, if I understand the question correctly.
Okay, 2 questions. The first question is that the 1.5% for Nordhaus refers to the subjective rate of discount of the utility function. So to get the market rate of interest for the Nordhaus model, they use something called the Keynes-Ramsey rule. So then there's 1.5% plus inequality aversion, which is about 1.5, plus the rate of growth. That's 2. So then you come up with about a 4.5% rate of interest rule for the Nordhaus model, and that's indeed much higher. So you're correct. So I should have been clear on that. But it's basically the subjective rate of utility discount. That is 1.5%, and that leads to these quite high rates of interest. So maybe I should go quickly to this graph. I don't see it's a 30% decline for 3 degrees. So it's a 30%. GDP per capita is minus 30. If you go 3 to here, it's minus 30%. So at 3 degrees, you get a 30% decline in world GDP. Is that correct? Is that now clear? So it's not an increase, it's a decrease. So thank you for that clarification question. It's very important. And just like in DICE, you get a much smaller decrease. It's like just a few percentage points. And I think that's much too small. So that's the answer to the second question. Okay. Any more questions? No?
I think we're fine. Thank you, Rick.
Okay, so just to point out, that is purple line, that's the Nordhaus line. It takes much longer before the end of the green transition because it's much lower carbon prices and much slower. Whereas the IPCC approach, which is not such a bad approach, leads to a faster green transition. It's about by 2050. And it grows much faster, the rate of interest R. It also starts a bit higher because the Nordhaus model doesn't allow you to stay below 2 degrees. It goes over 2 degrees. If you take the Berg things, it would be like this. Like this. It would be somewhere up here. It would be slow, but it would start much higher. And it would start up here. It would be a very quick transition. Okay. So you can ask, there is a paper by Christian Gollier. You can read any of these books on climate change and finance. They are really very good books to read. But he makes the case that most of these integrated assessment models use much too high rates of interest, say 5 to 12%. The United Kingdom even uses 50% per year, which is ridiculously high. So he says that's a big procrastination of carbon pricing. And I understand why politicians do that, because if they delay it, then it's for their successor to pick up the political damage of carbon pricing. So he did an asset pricing approach. So let me not go into the details of that. But then but the end of the upshot of it is that the risk-adjusted rate of interest to use for the growth of carbon prices is about 3.5%. So it's more than the growth rate of the economy, more than, which is what I've used in the figure above. It's not 2%, but it's 3.5%. But it's not 12% or 15%. So it's a bit faster, but not ridiculously fast. And so that's very important, that if you get these models, these results coming out, if you had something like 12%, you start, that's the logic of exponential growth. You start with almost nothing, and then all the high carbon prices are in the future. So it's very important to use a reasonable growth rate for carbon prices. And I would say, if you're going to do the IPCC approach, so to my friends in the network for greening the financial system, to my friends using the integrated assessment models, I say, please use 3.5% per year, and do not use 5, 12%, or 15% per year. It's a crucial thing. Anything you come out of that, it's very inefficient if you use a high growth rate of carbon prices, and it leads to all kinds of green paradox effects, and it's not so good. So let me move on. So I said a little bit, if you're going to have these carbon prices, there's another famous Nature paper, which most of you will know, by Chris McGlade and Eakins in 2015. Very easy read. Just one, you sit in the bar for half an hour and you've read it. And all they say is that a third of oil should be kept in the ground, half of gas, and about almost all of coal. And you should keep all of the Canadian tar sands, all of the Arctic stuff. You shouldn't even touch it. But the problem is, then, if you look at and it's still true, it's even more true today than it was then. If you go to all the annual reports of all the big oil companies and you count up their reserves and their probable reserves, they are 10 times larger than what the carbon budget is. So really, that means two things. It either means that Shell, BP, ExxonMobil, all those firms, that they are extremely overvalued, and that you should really short them. So to make money on the futures market, you short them. Or alternatively, the other hypothesis is that nobody believes that carbon pricing is going to be taken seriously in the near future. But this is not what is stranded assets. This is what I would call unburnable fossil fuel. We have all these fossil fuel reserves. And if you really want to stick to 1.5 degrees, we cannot burn it. The only way we could possibly burn it, if we put it all back into the ground again. But given that we have not made much progress with CCS, that's a big something. Remember that all the IPCC calculations assume a huge ramping up of carbon capture and sequestration. Without doing it, they would never get it. Okay, so that's my final point on that. So let's say something that I already said, that if you have tail risk, if you have tipping points, that would push up carbon prices even more. The best paper to read on that is, and it's an enormous study. It's a huge amount of work. Is by Kai and Thomas Lonczak. It's in the Journal of Political Economy 2019. I recommend everyone to read that paper. I've got some papers on tipping points as well, but I bow deeply for this paper, and it's the best paper on tipping points and tail risks you can read. It's also in the best journal of the economics profession, so please read it. But basically, the upshot of it is, if you allow for tipping points, so the risk that with global warming, the risk of the Greenland ice shield melting, the risk of the Antarctic ice sheet melting, the risk of the Gulf Stream reversing, the risk of the permafrost melting. If those goes up, all those risks go up with global warming. And if you then price those risks in, then the carbon price goes up by a factor 4 to 8 times higher. So this is a hugely important paper. And then what can also be shown, not in this paper, but in other papers, that if you have different types of tipping points, they can start cascading. And when you get this tipping the dominoes, then the increase in carbon price is even much more gigantic. So these are things that are missed with this IPCC approach, but are still nevertheless important. So let me ignore this for the time being. So no, let me. How much time have I got left, Emmanuel?
I would say if you speak for 5 to 10 more minutes, that would be great, and
okay,
leave us 10 minutes for the questions.
Then I will go a bit on the empirics. I think that's better. So there is this idea that not only unburnable fossil fuel, but you also have the idea that there may be due to policy uncertainty, due to uncertainty about the breakthrough technology of renewables. There may be certain breakthroughs, together with the fact that most assets are very costly to reverse, to reallocate, to reuse. Then you also get stranded assets, a risk of stranded assets. That's very different from the unburnable fossil fuel. So that's the unburnable fossil fuel is a physical risk, but it can also lead to sudden revaluations of financial assets and to the risk of stranded assets. So, for example, we know from the work of Ben Caldecott and others that many coal-fired power stations, but also steel factories and cement factories, probably have to scrap investments before the end of economic life, if you really want to stick to 1.5 degrees. So it's important to distinguish these transition risks or these policy uncertainty risks and physical risks. So what I'm going to argue, therefore, I'm going to look at is empirical evidence. So there are 2 very important NBR papers which just came out, and they are, one is by they're both by Patrick Bolton and Kaspecic, and they show something. And then the question is to you, I should have asked that to the audience. What do you think? Will the returns on those assets, will they go, and will they be higher or lower when they're carbon intensive firms like steel, cement, or oil majors? But it's interesting because when I did my own private survey on that, most people say it goes negative. Indeed, there's a whole literature that those firms get lower returns because they're so dirty. But that's not what the evidence say. The evidence says there is a carbon risk premium, a positive carbon risk premium. So and the reason is that investors, pension funds, institutional investors, they demand a higher return from steel industries, cement industries, oil majors, etc., to be compensated for the fact that these firms will have to change and will become maybe less profitable in the future. And that's even when you account for all kinds of other financial factors like the French factors for size, book to market, momentum, and all that stuff. And it's true for the United States, but it's also true for across 80 other countries. So really, what you can use is something called the Carbon Disclosure Project, and they gave emissions at a company level. Scope 1, direct from production. Scope 2, indirect from the purchase of electricity, heat, or steam. And Scope 3, from the production of materials and other inputs. And then what you can show that the carbon premium is positively related to emissions and change in emissions, but not to the emissions intensity. So emissions reflect, is the suggestion of this empirical work, a long-term risk exposure. So what they find, and this is quite astonishing, that's this third bullet, that a 1 standard deviation increase in level and change of Scope 1 emissions leads to higher returns of 1.8% and 3.1% per year in stock returns. That's quite big if you get it on a yearly basis. For Scope 2 emissions is 2.9 and 2% per year. For Scope 3 emissions is even higher, 4 and 3.8%. So there is this big evidence for carbon risk premium. There's an alternative hypothesis called the divestment hypothesis. So people say, no, that's not true. People are divesting from sin stocks, from bad stocks which like oil majors and steel factories, dirty stocks. So more and more institutional investors are using exclusionary screening based on direct emissions intensities. That's true. That firms with Scope 1 emissions are underweighted in portfolios, but the stock returns are not affected. So this divestment hypothesis is not correct. Then the third hypothesis, which a number of papers have, like In et al. And Garvey et al., they have the carbon alpha hypothesis, or maybe better called the market inefficiency hypothesis, and they say that markets underprice carbon risk, and therefore they do well by green investing. So it's completely the opposite of Bolton and Kaspecic, who actually reject this hypothesis, and I think for a very good reason, because their econometrics is much better. They control for industries, firm characteristics, and known risk factors. But what this market inefficiency hypothesis said is, no, if you invest green, you make more money than if you invest in brown assets. And that turns out to be a fable. That turns out it would be nice, but it's not true. You get a higher rate of return on risky assets like Shell and fossil fuel assets and steel assets, but the risk that they go down is stronger. And the reason why you get a higher rate of return is because they're more risky. So more riskier to get a higher rate of return. I think there's the jury is still out. The literature is not clear on this. So it's very difficult to model these models, like in the Network for Greening the Financial Systems and other people, if you're not sure yet which of these two hypotheses are correct. I stand firmly with Bolton and Kasperczyk, but there are still a lot of papers coming out supporting the market inefficiency hypothesis. So this is the paper in Park and Wong. They again do this for the US firms, and they basically show that you can get if you go short, you go long on carbon efficient firms and you go short on firms with high carbon intensity, you get abnormal returns of 5.4% per year. It's colossal. So this is completely the opposite of the paper by Bolton and Kasperczyk. They're diametrically opposed. In our profession, we need to sort out what this is, and that paper is not a bad paper. So we should need more research on the empirics. And Garvey, Iyer, and Nash, they test for firms that have a lower ratio of carbon emissions to sale, are less dependent on carbon, and have stronger future profitability and higher stock returns. They give evidence for that. That paper is econometrically not so good, but still also diametrically opposite to Bolton and Kasperczyk. Then the last paper, and perhaps I will finish with that. There's a recent paper by Donadelli et al. And they do something interesting. They search the internet and they look for terms like climate change risks. So they use machine learning to come up to that. And then they get an awareness of climate change risks, that measure here, from Google searches. It happens to be very strongly correlated with environmental policy strategy. And then they do a panel regression, and they try to explain the market to book ratio, slightly different from returns. But the findings are very striking. The findings are a bit like Bolton and Kasperczyk. So first they show that the stock market value of US oil and fossil fuel firms have fallen enormously over the last 20 years. So they're high rate of return, but their stock market values. And I think over the pandemic, that's become a lot worse. But the main empirical findings that as markets have started to price in the climate transition. So as climate awareness has increased, then you have to pay a bigger, you can demand a bigger return from these dirty firms as an investor. So that's in line with what Bolton and Kasperczyk find. So they find, again, a carbon risk premium, and furthermore, the carbon risk premium becomes bigger the stronger the climate awareness. So again, final points, and then maybe I will stop. Some investors have non-pecuniary preferences for green companies. They may be ethical. In that case, they would accept a lower Sharpe ratio in order to speed up greening of the economy. They wouldn't keep dirty assets as a hedge. They would be seen as being unethical. And secondly, another big phenomenon, and this is paper by De Angelis et al., they looked at nowadays there are quite a few environmental impact investors. So if the fraction of assets managed by green investors, if that doubles in their portfolios, then the carbon intensity of the companies in what portfolio drops by 5% per year. So there's evidence that these environmental impact investing works, and that investments have ethical preferences also clear. So I should try to finish. I have other slides, but I believe it for another occasion. And in any case, my chairman, Emmanuel Campillo, has done a lot of work on that. But then the question is, what does all this mean? When we look at financial networks and we do climate stress tests, and when we do proper networks, we have what I call endogenous networks. My students are working on that and trying to use endogenous networks where the risk of defaults are also endogenous. How do these things and where the pricing of these assets, which are necessary to understand those financial networks, which are crucial for climate stress testing, are clearly endogenous. You can't use a spreadsheet, so as I've seen in certain studies. So really, I think we're still at the beginning, although people like Battiston, or Campillo, Stolbova, and others have done grand work in starting this idea of stress testing and networks. I think we need to learn more about networks themselves, about the structure of the networks matters very much for how fragile the financial system is. So we want to learn more about the work from Acemoglu, Carvalho, and others, what this means for the structure of networks. And we need to know more about how to empirically set up an endogenous network where pricing of these assets reflect, I would like to be more like what Bolton and Kaspersky do, and where we allow for these transition risks. I will stop here. I thank you for your attention, and I try to have a little seminar where I would present more the issues rather than having one technical paper, but this is what I was asked by the organizers. So I hope this is okay. Thank you very much.
Rick, thank you very, very much. So let me immediately move to the audience. Can I ask you, if you want to ask a question directly, then please raise your hand like Carly Gash has done. I will give you the floor in a second, Carly. Or type it in the Q&A or in the chat. If you do like this, I will read it to Rick. So before giving the floor to Carly, let me just forward you a question that was there since the beginning. So related to the first question that we asked the audience. So Stephen Cicchetti asks, the first question is really two questions. Central banks should be concerned about climate change. Everybody should be concerned. But what policies should they actually change? That's a different question. So I don't know if you have any specific view on what exactly central banks should do.
Okay.
I will, if you don't mind, I will gather 2 or 3 questions and you can answer them. Is that fine by you?
Yes,
Rick?
fine with me.
Yeah. So Carly Koralbayeva, can you unmute yourself, or can the organizer unmute Carly? Yes.
Oh, okay. Can you hear me, right?
Yes. Hi, Carly.
Thank you so much, Emanuele, for organizing this seminar, and thank you so much, Rick, for such presentation, very insightful and very useful information. So first of all, I was wondering if, as a result, empirical result by Bolton and Kaspersky, somehow theoretically relevant to the finding of my paper with Elizabeth Baldwin and Yan Kai. If you remember, our theoretical result was that so investors, if they anticipate that, let's say, their investments will become obsolete in the future, then they will stop investing because they would like exactly to generate these higher profits in the short term in order to compensate for this infrastructure or whatever investment become obsolete in the future. And the second, I have a question regarding, I guess, result by this, I guess, a set of papers which follow up Bolton and Kaspersky discussion on your presentation today. So I was also wondering, I would like to know your opinion on, let's say, production of some commodities which will be required for green transition. For instance, like copper and I guess some other commodities. But we know that mining is inherently a dirty sector. So how do you think we should reconcile this sort of idea that we need those commodities for green transition, but at the same time, they're dirty? Thank you.
Okay, so let me take thank you very much, Carly, for those 2 questions. I'll do you first, and then I'll come to the first question. The first point is there's a very interesting paper by Kai, Elizabeth Baldwin, and Carly Gash in the GEAM. And there they show that a transition of the economy may lead to the opposite of a green paradox, may lead to a boom in green investments up front. So really, how does it relate to Bolton and Kaspersky? In a sense, you can say that the investors are demanding a higher return on holding those risky assets because they fear the prospects sketched in the paper by Carly Gash and her co-authors. So I think it would be nice to have more papers where you really take the risk of a policy change as a regime shift, as a kind of policy tipping point. I've seen very few papers on that, actually almost none. But there's many papers on tipping points, but you can also have a tipping point for policy. And then you could then the tipping point would it go to a Baldwin-Kaligash world, and then I think I would swear that then you would get these carbon premiums which Bolton and Kasperczyk found. So maybe Carly and I, or maybe Carly and some other people will show this this extension, and that would actually be quite useful to have that theoretical backup or numerical backup. Then Carly Gash's second question is about copper and the materials needed for the green transition. So I know that Carly Gash has a past, like myself, as an expert on natural resources, and a lot of her work has been on that. Not only that, but also on forests. But it is true that, for example, for the green transition, for example, batteries, we need special material, which is often located in only 1-2 countries in the world. And often these are very conflict-prone countries, sometimes in Africa. So then all the problems, so there's this literature on the natural resource curves and the literature on green transition. There's very few papers which combine these two literatures. And I think Carly Gash is suggesting that more work could be done on that. I would like to add, there is also, of course, that some of this material for batteries can also be mined from the oceans, the bottom of the oceans. And there's a whole new literature on natural resources from the oceans and who owns it. And that mining from the oceans may very well be needed to get the raw materials needed to finance the green transition. So in short, there are a few technical papers on that by engineers, but the economists have not done much on that. So I think that's an interesting area. Then to come back to the first question, which was about the macro aspects and what should central banks do. So I think there is, so these are the type of questions. So should a Taylor rule respond to global warming when output and competitors deteriorate? And when inflation goes up when you price carbon? Well, that depends. Again, in the macro literature, it depends if there is divine coincidence. But there are some papers. There's a paper by Richard James, which shows that the negative effects of carbon pricing and output are curbed if you rebate the revenue via lower income tax and rather than via transfer. And that's particularly good, that effect. It's a lot of price and wage sluggishness. There's papers which show that pro-cyclical carbon tax cuts risk premium, boost welfare. Then we know that if you have liquidity costs of banks, that they increase with the carbon intensity of the portfolio. So maybe banks favor low carbon assets, so easy to finance the transition. So maybe it is a story that maybe the interest rates should be really, that are being charged. I already mentioned it in my talk, should maybe be emissions based. So there is actually work that shows that that dirty firms have to pay a higher rate of interest when they borrow money. Maybe central banks, when they do their prudential functions, should have different weights for loans for green investments and brown investments. So you may want to ease reserve ratios for low carbon lending and have tighter reserve ratios for high carbon lending. You may use central bank collateral to cut emissions. So you can think of a lot of macro policies. These are just a few. And I could talk a whole 2 hours on this, but I'm not going to do that now. But I think that the idea that central banks should do it, there are very few papers on this literature. I think Carly Gash might also have a paper on this. I might have forgotten you, Carly Gash. But I think everybody would agree that this literature is very small. I'm a macroeconomist, and I don't think it's always very good. Not because the people are not very good, but it's just it's a very beginning literature. We should really attack very careful what the market failures are. Is it just that the labor market fails? Are there capital market imperfections? Is it default risk? And to put all that and then climb it in there directly, I've seen very few papers which do that in a proper context. But I think it's a very busy field. In the last 2 years, many papers are coming up. I noticed that also Emmanuel has started writing on it. But I think these are initial papers. I think the best papers are still to come, and probably, hopefully, by the same people who've been writing them. But I noticed that in my macro friends, and the best macro people are getting interested. So I suspect a lot of good paper will come out, and that's good. That's the way these fields go. So and of course we know that central banks are interested, was Christine Lagarde, but also more recently also the former governor of the Bank of England, Carney, have all argued for that the role for central banks in fighting climate change. They have it's seen to be part of their fiduciary duties, and I think maybe the economists, except for the few papers I just mentioned, are perhaps behind the practice as being encouraged for the network for greening the financial system. Thank you.
Thank you, Rick. If you don't mind, I will forward you 3 final short questions that came from the audience. So there is one by Pascal Wheel asking, ex ante, wouldn't risk-adjusted returns on a green portfolio have to be lower than the overall market? And then there are 2 questions by Arjun Mahalingam. So the first one is there any point in introducing a carbon price in an economy which simultaneously subsidizes fossil fuels, which goes back to one of your first comments? And then a second question, do you have any thoughts on how to stimulate the currently low EU ETS prices? The question says how to simulate, but I would imagine he meant how to stimulate. If not, please write in the Q&A.
I think these are 3 very exciting questions. So you might have to help, by the way, to remind me. But the first one was do green assets, shouldn't they have a lower rate of return, a lower return than the average?
Risk-adjusted returns.
Yeah, yes. Lower risk-adjusted rate. They're all risk-adjusted rate of return. And the answer is yes, of course they are. And that's indeed exactly the consequence of the Bolton-Kasperczyk empirical results, that the carbon-intensive assets, they demand a higher return to be compensated to the risk, whereas the green assets therefore they can get away with giving a lower rate of return because they're less risky. So this is an excellent question that sums it up in a nutshell. But notice that goes against these other papers by In et al. And Garvey et al. So, but I think if you believe Bolton and Kasperczyk, that's exactly the intuition. So thank you very much. Then the 2 questions of the final questioner. The first one was, remind me again, Emmanuel.
Is there any point in introducing a carbon price when we have fossil fuel subsidies?
Yes, of course. Ideally, you immediately get rid of the fossil fuel subsidies for coal, airlines, and a lot of the exemptions. But sometimes it's done sometimes it's done deliberately, like steel, they get exempted. But instead of exempting, or airlines, instead of exempting, you should let them pay the full carbon price, but maybe get them a production subsidy. So the work of people like Meredith Foley from Berkeley suggests you give them a production subsidy, which is a second best one for the border tax adjustment. And yes, you should both tax carbon and get rid of subsidies immediately at the same time. If I were to be in the lucky position that the Dutch government would ask me to be the Minister of the Environment, that's what I would announce on day 1. Your second question is extremely interesting. Is it not too low? So here I might like to air a proposal I also proposed at the Sintra conference of the European Central Bank. And it's also being proposed by Christian Gollier. It's also being proposed a long time ago by Dieter Helm, Cameron Hepburn, and Richard Mash. And they would argue, the argument is we need a independent central bank for carbon permits. So you could argue that just like the central banking and money is too important to leave to politicians, we delegate it to central bankers with a clear mandate. We also delegate the task of getting emissions down to an independent authority, an independent emissions authority, if you want, or an independent carbon central bank. And their task would be, if they see that the carbon prices are too low, and as they are in the market at the moment, and that emissions are not coming down strong enough, like emissions should be really coming down during this pandemic, but they're not, then they should buy up permits on the open market to push up the price of carbon and to make sure that emissions are being cut down again. So that would be my proposal, to have an independent carbon central bank or independent emissions authority with the sole mandate of getting emissions down from today until 2050, get back to net zero by 2050. And maybe half by 2035. And then the question is, do you do that at the European level or the global level? Well, let's start on the European level, and let's try to do it as well, and then they have to coordinate those actions. But I think to leave it just to politicians, it's too dangerous. Of course, there has been a reform of the ETS in Europe a few years ago. It was called this stabilizing mechanism. And that already included an element of buying up when prices are too low. So there's already an element of that. So I'm asking for that to make it stronger by giving them to an independent authority. But they're two great questions, and also the first one was an extremely good clarification. Thank you very much.
Rick, so let me thank you once again for this great talk. Let me thank the audience and the organizers for putting this webinar together and attending. Before we close, can I please remind you that there will be another webinar in 2 weeks on Monday, December 14 at the same time, so 12 New York and 6 p.m. Central European time. In this case, the speaker will be Gregor Semeniuk of University of Massachusetts Amherst, who will speak about low carbon transition risks for finance. With this, I thank you all again, and I'll see you in 2 weeks. Thank you.
Thank you.